Hi, everybody. This is Peter Schiff. It is January 30th, 2015. And today, the U.S. government released its first estimate of GDP growth for the fourth quarter of 2014. And remember, the third quarter of 2014, we had that 5% number that got everybody excited. And as I explained at the time, I thought that was an anomaly. I thought it was driven largely by a big build in inventories on anticipation of more robust consumer spending in the future, and because of the quirk involving expenditures on Obamacare, which were largely reflected in that third quarter. So I thought we would have a substantial slowdown in the fourth quarter. And in fact, that's what happened. The government reported GDP growth in Q4 at 2.6%. That was well below the 3.2% that had been forecast. And of course, the forecast was higher earlier, but they had revised it lower to get down to 3.2, and it came out at 2.6. But I think what's even more remarkable is if you look at the inflation assumption that the government made. Remember, they always have to deflate the nominal GDP to get a real number. Now, last quarter, when it was 5%, the deflator was 1.4. So that meant nominal GDP growth was 6.4, and then when they took out the 1.4, we were left with 5. This time, the estimate was for a 1% deflator. Instead, it was 0. The government assumed 0 inflation on an annualized basis for Q4. So nominal GDP was also 2.4. Now, if we had 1% inflation, like everybody assumed, right? If the deflator was 1, then instead of reporting 2.6, it would have only been 1.6. And if the inflation was the same in the fourth quarter as they assumed for the third quarter, it'd have been 1.2. Now, I don't know what it is. I don't believe any of the numbers. I think inflation is more than the even 1.4 that we got last quarter, which means the economy is still in contraction. But even if you believe the government's numbers, you got to scratch your head at the most recent number being so much lower than people had estimated, and then still only producing a 2.6% growth rate. Now, most people on, the commentators I saw kind of shrugged it off, because they're still optimistic that, we're going to get 3% growth in 2015. Why? I mean, why would we get 3% growth? We only got 2.4 for the entirety of 2014. Right? And that was the best in 5 years, 2.4. Last year, we did 2.2. I mean, not that much better. For all the hoopla about this great recovery and this plunge in the unemployment rate, we barely improved upon last year's 2.2. And remember, we had QE for almost the entire year, and we had 0% interest rates for the entire year. 2015, according to the Fed and according to what everybody believes, we're going to have no quantitative easing in 2015, and sometime around mid-year, the Fed's going to start raising interest rates. If that's going to happen, if we could only manage 2.4% with the Fed throwing everything but the kitchen sink at the economy to stimulate it, how are we going to do better than that this year without any of that stimulus? Now, of course, I've always argued that stimulus doesn't grow the economy. It actually retards economic growth, but it does goose the GDP, right? Because by encouraging us to borrow and spend money and by propping up asset prices, it does make the GDP go up, but at the expense of the real economy. But the minute you stop the stimulus, all of the stimulus-related phony growth goes away. But the reason the average man on the street isn't experiencing growth is because phony growth doesn't deliver genuine gains to most people. But the minute you stop the stimulus, whatever you manage to achieve, whatever phony growth you achieved, goes away. And that's what people still don't understand. That any growth that people believed exists goes away when the Fed stops blowing air in the bubble. And that is already happening. Look at the sharp deceleration between Q3 and Q4. Now, based on the economic data that has already come out thus far in January, I think that the first quarter is going to be yet another reduction. In fact, we may only be 1 point something for GDP growth for Q1. And then where's it going to be in the second quarter? 0? Is the Fed really going to start raising interest rates as the economy is on the doorstep of a recession? I don't think so. But again, people haven't connected these dots yet. They still assume that the recovery is genuine when it's not. In fact, the only reason that the U.S. economy appears to be doing better than Europe or Japan is because we had all this stimulus. Certainly, we had a lot more stimulus than Europe. But now that we're taking the stimulus away, our economy is going to tank back into recession. Yet you got the Europeans looking at the supposed success that we had, and they want to emulate us because they think it's succeeded, but it's a huge failure because you can't judge the success of quantitative easing and 0% interest rates until you've effectively ended the policy. That means you raise interest rates back to normal and you shrink your balance sheet back to normal and then take a look where you are. Because if we did all that, we would find that we have dug ourselves into a much deeper hole than when we began digging, right? Than when we first started with these programs. And then nobody would want to emulate these programs. Now, the market initially kind of shrugged this off, the stock market, but by the end of the day, by the time they rang the closing bell, the Dow was down about 250 points. And this also was the last trading day of the month of January. So thus far in January, thus far this year, the Dow is now down 3.5% in the month of January. S&P a little bit better, only down 3%. Now they have something called the January indicator, or January effect. They say so goes January, so goes the year. I don't know how much validity there is there. I don't know how accurate that barometer is. I think it was more accurate, I think, in the past than it's been in the last 10 or 20 years. But regardless of the January effect, there are plenty of reasons to believe that this would be a down year in the U.S. stock market. Gold, on the other hand, had a much better January, up 8.4%. Silver up 9.8%. And in other currencies, gold and silver were even stronger because the dollar index was up 4% in January. That means the price of gold and silver were up a lot more in terms of other currencies. Gold stocks, they were up 23% as measured by the Huey index in the month of January. Now, I can't remember the last time you had this big a divergence in a January between gold stocks and the Dow. Maybe somebody could check some kind of almanac and figure that out. But to me, that might be significant and indicate that something is coming. But ultimately, what I think has to happen, and it hasn't happened yet, is that people are going to have to connect these dots and get their arms around the fact that the U.S. economy is not nearly as prosperous, that this recovery is not legitimate, and that it cannot sustain itself. I mean, how can anybody believe, right? If you believe that the stimulus worked, right? If you believe that quantitative easing and 0% interest rates stimulated the economy, then how can you take away the stimulus and have the economy perform better without the stimulus than it did with the stimulus? And you would have to acknowledge that if you take away the stimulus, you're going to get less growth. And that's what's going to happen. Yet everybody expects more growth. In fact, if you look at the most recent FOMC statement, I went over that on my podcast a couple of days ago. So if you didn't listen to that, go listen to the podcast. But the Fed was very upbeat about the economy, about the employment situation, more upbeat than they've ever been. Right? Yet here we have a big drop in Q4 GDP, and I would expect that to continue. And yes, we did have a reduction in the unemployment rate, but I think that's going to reverse in 2015. Plus, you got to think about this. GDP growth was only marginally better in 2014 than it was in 2013. Right? We went from 2.2 to 2.4, right? Not that big a jump, especially considering we still had QE and we still had 0% interest rates. But the unemployment rate plunged. Yet all these employed workers didn't do much to lift the GDP. Why not? Well, the reason is we didn't have a big jump in the number of employed workers. We just had a reduction in the unemployment rate because the people who used to be looking for work quit looking. Or some of the people who were holding out for full-time jobs took part-time jobs, and so these part-time jobs were not that productive, and therefore they did not do much to influence the GDP. Now, I do believe, though, that you are going to see more talk from the investment community about why the Fed should not raise interest rates in 2015, or at least in mid-2015. And they'll blame it on the strong dollar, they'll blame it on inflation being too low, or problems in Europe. But all that is just an excuse. It's just a smokescreen. It doesn't matter. Even if none of these problems existed, the air would be coming out of the U.S. bubble economy anyway. But sure, they have to blame it on something. They don't want to acknowledge that their cure only made us sicker. So they'll come up with an excuse why not to raise rates. But I believe that this bubble is so big that merely not raising rates is not going to do enough. Right? And because people are going to be anticipating rate hikes at some point, that's still going to be weighing on the market. I think the only thing the Fed can do to turn the situation around is launch QE4, which of course is going to be very dangerous for them to do that. Although I think the one benefit the Fed has is that the dollar has already risen so much based on the anticipation of higher rates that when they disappoint the market and come back with QE4 instead and the dollar plunges, it's plunging from an elevated level. So it's not necessarily a dollar crisis. That dollar crisis would be postponed for a while because of the heights to which the dollar has been lifted based on this false expectation of a tighter Fed based on the misconception with respect to the U.S. economy. People mistake this bubble for a genuine recovery. That's why they think the recovery can sustain itself without the stimulus. It can't, right? It's just a bubble, and without the air, it deflates. Now, one of the reasons that the dollar didn't react more negatively to this much lower than expected fourth quarter GDP was because we had the supposed bad news that came out of Europe earlier in the morning that European inflation was once again negative. I think the headline number was a minus 0.6, right? But the core number, if you strip out food and energy, was still plus 0.5. So prices are still rising in the Eurozone, despite the fact that the economy is weak and you have lots of unemployed people. But because of a decline in energy prices and food prices, because food prices were also down, right? Because food and energy prices went down, the headline inflation was negative. Now, everything I read about this said that this is of grave concern, that the ECB is worried about these developments, and it validates why they did QE, right? They're very concerned. Why? Again, why are you going to be concerned if gas prices go down? Or more importantly, let's talk about food prices, right? Why should central bankers be worried if eating becomes less expensive? I mean, everybody wants to pretend that they care about the poor. Well, food is the most important thing for the poor, right? I mean, they have to eat. There are some people that might be so poor that they're starving, right? Well, what alleviates starvation? Inexpensive food, right? The more food there is, the less it costs. And poorer people spend a much higher percentage of their incomes on their food. And of course, if they can spend less on food, well, then they have more money for other things. Or maybe they can buy better food. Hey, maybe the poor person could buy a steak if the prices come down low enough. Why should this worry central bankers? They're worried that some poor person in Europe is going to get a break on his food, that he's going to be able to eat for less money. I mean, this is ridiculous. And of course, also it's utilities. Energy has to do with your heating bill or your air conditioning. I mean, isn't it good? There are some people that are so poor they can't afford to turn on the heat. Maybe lower prices for energy will let them take off their sweaters and turn on their heat, right? But no, this is what's concerning the Europeans, that the prices are too low. Look, this nonsense is getting to extremes. Yes, there is a weak economy in Europe. And yes, prices are not rising. But the fact that prices are not rising is not why the European economy is weak. If anything, it is the other way around. It is the weakness in the economy that is putting some downward pressure on prices. But you can't turn around the economy by forcing prices up the lower prices actually act as a buffer to the weak economy, cushioning this thing. The fact that food prices and energy prices are down makes it easier on the people who are unemployed. If they're succeeding in creating inflation, you're just going to compound their misery. Now, here's the interesting thing, though, about deflation or about falling prices that result from a weak economy. That only happens in the beginning of a weak economy. See, if you have a strong economy that gets weak, prices can come down. Why? Because businesses have more inventory that they need to liquidate. Maybe you have some companies that have a going out of business sale. And so initially you get a decline in prices. But the decline in prices is not causing the economic weakness. It is a result of it. Right? So, but what the Europeans are doing is thinking, aha, let's focus on the result, right? Let's focus on the symptoms. And let's try to cover up the symptoms, and that's how we're going to cure the disease. No, you got to cure the disease. The disease is that the economy is weak. The symptom is that prices are going down. Why is the economy weak? Too much government, too much regulation, especially in the employment market, too many punitive laws, making it expensive to hire people. There are all sorts of things that the governments are doing in Europe to screw up the economy. None of these problems are going to be solved by creating inflation. They're all going to get compounded. But I said the original effect of a weak economy could be to push prices down. But the longer term effect is to send them back up, right? Because once the inventory is liquidated, once all the companies that are going out of business are out of business and they're not having their sales anymore, once you diminish capacity and you reduce supply, then prices can start to go up. The problem is you've got all these central bankers that are reacting to this slight decline in prices as if that's the problem. And now they're printing a bunch of money, right, in order to create inflation. And the fact that there's a lag because the weakness in the economy is interfering with rising prices. In fact, if central bankers weren't printing so much money, not only in Europe, but in Japan and the United States, if they weren't printing so much money, prices would be falling faster, which would be a good thing. The fact that they're not is one of the reasons that the economies are so weak. But ultimately, what's going to happen is these temporary factors that are mitigating prices are going to go away. And now prices are really going to start to rise. But because you've also printed all this money, they're going to rise even faster. So these governments that are creating money, creating inflation deliberately, because their weak economies are temporarily pushing down prices, and they're overreacting, and they're attacking the symptoms instead of the disease, when this thing turns around, inflation is going to run out of control. And the problem is they take on so much debt, right? There's so much new debt that is taken on in order to stimulate the economy, so to speak, but to create inflation, that by the time inflation rears its ugly head, there's too much debt for the central banks to fight it. Because now if they raise interest rates, right, what are they going to do? That's why they say, once the inflation genie is out of the bottle, it's too late to do anything about it. I've seen or I've heard some people say, I think it was Larry Summers, said that the Fed should not fight any inflation until they see the whites of its eyes, meaning that we shouldn't raise interest rates now, we shouldn't be preemptive, we should wait until we can really see the inflation before we do something about it. But the problem is, if you wait that long, it's too late to do anything about it, and of course it's too expensive to do anything about it, because the more debt that we accumulate to create the inflation, the less likely we are to be able to service the debt when we have to fight that inflation, which means governments are reluctant to slay that dragon, and which means it gets worse and worse and worse. So now the inflation spirals out of control, and you get a runaway or a hyperinflation. Now, I know everybody like the Paul Krugmans are going to say, oh, Peter Schiff has been warning about this for years, and it hasn't happened. That's right. It hasn't happened. It doesn't mean it's not going to happen. But what I'm tired of is all the people who say, well, stimulus is going to create economic growth. Well, it hasn't done that either, right? They've been doing all this stimulus for years and years and years, and that hasn't borne any fruit. Yet they want to claim credit for stimulus working, yet it hasn't. Yeah, sure, they can point to the reduction in the unemployment rate, but it's not because they've created jobs. That's not how the unemployment rate was supposed to go down, according to the Keynesian playbook. We were supposed to create a bunch of jobs, not discourage people from looking for them. And of course, all of these jobs, or a lot of these jobs that were created in the latter part of 2014, were created based on the anticipation that the recovery was real and was going to accelerate in 2015, not relapse back into recession, which is exactly what is going to happen. The only question in my mind is, how long is the Federal Reserve going to maintain the pretense of economic growth and pretend that it stands ready to raise interest rates at some point, when it really is planning on launching QE4 that will be larger than what they're doing in Europe? If they don't launch QE4 this year, I think the stock market will be down. And not only will the stock market be down, the real estate market will be down. And remember, both the stock market and the real estate market are the twin pillars upon which this phony recovery was built. Right? And for those people who think that we're going to have more economic growth in 2015, 3% economic growth, which I think is still the consensus in 2015, how is that going to happen? Right? Without any quantitative easing, with rate hikes later in the year, with a falling stock market, with a falling real estate market, right? You're going to have the wealth effect working in reverse. In fact, they announced today that the home ownership rate just hit a brand new 20-year low. And the Fed hasn't even started to raise rates yet. How is this phony bubble economy going to grow faster under those conditions than it did last year under the ideal monetary condition? It can't, right? And that, again, is the dichotomy, right? The inconsistency that nobody seems to be able to grasp. Of course, they never seem to figure these things out until it's too late, until after the fact. Then they go back and say, oh yeah, of course, it should have been obvious. But how many people are talking about what's obvious before the fact? You know, the reality is, it is obvious. It's just that too many people have a vested interest not to see it. So they close their eyes and ignore, right, what they should see. And then only in hindsight, when they no longer have, the bias, right, because it's already happened, now they can go back and concede how obvious it should have been. But the reality is, it's always obvious. The problem is sometimes it takes a long time for the vast majority to figure out, right, what should have been obvious all along. Hey, that's it for today. Don't forget, more frequent updates are coming on my video blog, so make sure and subscribe to that over at schiffradio.com. And again, you can also look at them on this YouTube channel as well. Bye for now.